Great. All right, well, good afternoon, everyone. It is March 16th, 2022, and we are doing our first State of the Foundation update for the year. Of course, I'm Angie Tatro, the CEO of Central Kansas Community Foundation, and this is our approximately every quarter doing a little bit of an update on happenings at the foundation and also hearing from our primary investment managers, Greystone Consulting, and on occasion hearing from our accounting firm, Clifton Larson Allen, with Heidi and Katie. They happen to be on spring break along with Melinda Newell, our accounting clerk. So we won't be hearing from them today, but we will jump into a few highlights with first just introducing on the line. We have three of our Greystone Consulting consultants here. If you just kind of wave your hands. We'll be hearing from them after I do an update. We also have Becky Nickel, our community liaison, with us today. Thanks for joining, Becky. And very nice to have a former employee and now a board chair of the North Newton Community Foundation, Bill Hague. So thank you for being here, and we may have others join, and we'll just continue on as we go forward here. I wanted to share a few little highlights from the close of 2021 because we have not met for this meeting, just to share kind of where we were at the end of the year, and then we'll be kind of jumping into where we are now in March of 2022. So to begin, in 2021, we ended the year with 29.5 million in assets under management. We had 435 funds at the time, with that about a 20 new fund growth in 2021. And that growth came from 2,394 new gifts in 2021. That was 3.4 million in new assets to the foundation. We had a tremendous year in 2021 with additional impact to funds under our management, as well as new funds at some significant levels. So we're really honored to be managing those assets for our donors. We also, in 2021, distributed 620 grants. That does include scholarships. We do identify grants and scholarships as grants. And we made a community impact of $2 million in 2021. So a terrific year in 2021 with not only organizational growth, serving our donors, and then making community impact to causes that matter to them. So we're really thrilled about that. Just to share with you a little bit about where we are, just 2 months in for the close of February, we have 28.6 million in assets under management collectively. And it might be nice to point out too, when we talk about our total assets under management, it's not only with our primary investment manager with Greystone Consulting, but we also do have independent investment managers that manage some of our donor assets. And we have partnerships with Edward Jones, with Dellen Reed, Everence Financial. And we're really pleased to have those partners with us as well. And always welcome opportunities with donors that have gifts of over 200,000 to allow them to maintain that relationship with their investment manager. But for the bulk of our assets, they are commingled with our primary investment manager, Greystone Consulting. So yep, this year, we have already received 316 charitable gifts, and that amounts to 1.2 million in assets that have already come in the door in 2 months. So we're off to another great year with contributions and expansion of funds. We also have already distributed 117 grants, making community impact at over $350,000 in those 2 months. And I'll share our kind of high volume months tend to be March and April, where we're hearing from our donors to make their distributions from their endowments that have an available to spend balance, an ATS as we call it internally, but that moving average up to 5% available funds for distribution. And normally March and April, we see the bulk of those coming through the foundation for distribution. So we're off to a good start. The gentleman from Greystone will be sharing with us a little bit about the market performance here in a minute, but I wanted to share two other highlights from the foundation while we have your attention today. We wanted to share with you a little bit about our preparation for a new program at Central Kansas Community Foundation and our affiliates called Invest Central Kansas. We held a summit with our partners and our affiliate board members, along with the CKCF board and staff, on March 3rd, kicking off an internal kind of educational session to start bringing more of our region up to date on this new program, which is local impact investing. Impact investing is becoming a more of a common program arm of community foundations across the nation, and definitely here in Kansas. We're always kind of watchful. We kind of watch for a couple of years before we dip our toe into some of these new service lines. So we have a number of colleagues around the state that have been working on this endeavor. And the last year, we have a work group that has been working on it locally. And we're beginning to put the finishing touches on that model to roll out, we hope, yet in 2022. So there will be more information coming, but the main part of this is, and I liked how one of our speakers at the summit shared, it's not just investing in Wall Street, it's investing in Main Street. So taking some of our asset base and putting that to work in low interest loan programming. So this expands far beyond just the grant making that we do, where we give it out and it doesn't come back. This is a program where we can loan and have kind of that revolving door of assets going out and recouping some of those gifts for projects that sometimes just need that gap funding to push them over the edge to achieve the goals that make our community better. And I wanted to just highlight a couple of the target impact areas. This State of the Foundation is one place, as well as a recording of the summit that Becky can help definitely with our board members get access to. But I just kind of want to lay the groundwork that the areas that we're wanting to really focus on improving for the quality of life and improvement in our communities relate to things like amenities to keep and attract residents. So what are things in your communities that are bringing forth opportunities to draw young people in and preserve the current residents of your community? Business development and entrepreneurship. What are needs your community has from a business sector? And we know that entrepreneurship is growing by leaps and bounds. How can we support those entrepreneurs in our communities to serve and increase the business sector for needs that span across your community? Then housing and housing infrastructure, particularly housing needs that relate to our more vulnerable populations. Those may include persons with disabilities or low income housing resources. What are the needs? We hear this a lot of times in our communities, that businesses can't support their workforce because there's no place for them to live. So these are opportunities that might be able to be funded. And then the other category is just the general workforce support, with a real focus on child and family care. So how can we support not only our families with childcare resources? We hear this in almost every one of our communities, that childcare is a real, there's a lack of childcare in our communities. And then also just general family care. Our elder population too is another area that we're trying to keep people at home longer and support them and wrap services around them. So how can we do that and be effective to improve that quality of life in our community? So that's just a little bit of a highlight about kind of the top level areas. We have no perceived notion of what type of applications are going to come in when we do open up this cycle, but more will be coming in the next months. At this time, I think we're trying to target maybe by June, we would be launching a more formal announcement about the program, but that will be determined as we kind of get through these final tweaking stages of the program. But if you have questions, feel free to reach out to me. I'm happy to visit with you about that. We're excited to learn how our communities in Central Kansas are beginning to think about partners and resources within their community. And then the other announcement I wanted to make, Central Kansas Community Foundation, as many of you know, is a host foundation with 19 affiliates under our umbrella, us providing here in Newton the back office support, everything from the audit, accounting, fund management software, plethora of resources to help you do your effective work, to build relationships locally and make the communities stronger that you are providing services to. We have definitely recognized that with our growth, there's resources that we need to help augment our budget to keep supporting our affiliates in the way that we are. So we have a $15,000 goal this year with our online auction that will be July 13th through 19th of this year. So it'll be a virtual auction. So we look forward to having support and engagement with that auction to help augment our bottom line so that we can continue serving everyone across the region. So those are just a few of my updates today. I wanted to also just share my screen briefly to share our website, just a couple of reminders to our viewers today. Let's see if I can move everybody again. Just a reminder, if you've not signed up for our newsletter, we do a monthly newsletter the last Friday of the month. There's a quick button right here at the top of our website where you can click and put your information in, and you get put in automatically into our newsletter distribution list. I also wanted to bring attention to our Donate Now button. Staff has worked on updating this link for our affiliates to now be able to, and I'll go to North Newton, Mr. Haig, since we have you on the line, to show an easy button to get to the funds under management at, I can't do anything about that phone ringing, so I apologize. A quick button to get to the funds that are under management at each affiliate. So easy way for your constituents to find you and find resources within your community to make contributions to. So again, that's just at the top bar of our website for easy access for Donate Now. And then this last year, we implemented under the events tab, the foundation events calendar. And this now has, as events come up, like today's event, the State of the Foundation with the Zoom link, all of that information is on our calendar. And so for April, we have a new board orientation coming up. July, we start The Sky's the Limit. So anyway, just a quick reference to know, please feel free to access our calendar to see what events and activities are coming up. And there's lots of other information on our website as well, from applying for scholarships and grants to also donor resources. So let us know how we can help and get more information to you as need be. But those are just a few resources I wanted to remind everyone of in relation to the newsletter and our calendar. So from there, I'm going to turn it over to the Greystone folks. Who would like to begin? Chris, Robert?
Chris, I'll tell you what,
I'll be happy to start.
You begin,
Yeah, Rob's going to share a screen, and I can probably do mine a little quicker, and then we can leave the balance of our presentation time to Rob, because there are a lot of updates to what's going on in the market for sure. And the last couple of days have been good, I guess. Today markets are rolling, and yesterday they were a good day as well. But been a lot of turmoil recently, and Rob will get into the details of that. And then Angie, you've had so many good things going on, and a great year of 2021. And so I'll actually start with that. That's not on this report, but at 12/31, at the end of the calendar year, your one-year return was 10.48. And then the benchmark was 10.38. Oh, Rob, you pulled up December. I thought you had February.
I got
so,
you. Yeah.
Okay. Yeah, he does a great job. So yeah, 10.48, 10.38, just really good. If you look at that 3-year number too, 15.3 to 11.89. So just an outstanding year and a lot of good results and a lot of good long-term results as well. The 5-year at 9.82. I think we started around September of 17, so we're 4.5 years in. So that's why you don't have the composite benchmark comparable 5-year performance linking to some of your older performance. But all in all, a really good year for you. And I want to fast forward to the February numbers now. And again, a little bit sobering because of everything that we've seen year to date. You see that negative 5.6, benchmark negative 5. Last month, negative 2.2 compared to negative 1.5. Keep in mind, though, that the S&P 500 year to date is down 10.6%. The NASDAQ is down 17.5%. The Russell 2000 is down 12.3%. We've seen an increase in the Treasury yield for the 10-year up to 2.14. So this is just a catalyst for a lot of negative returns that we see across. Thankfully, we're not down 17% like the NASDAQ or down 12% or so in Russell's small cap index, as you will. But all that said, keep in mind that the objective, as you've defined it by your balanced fund, is to seek competitive market returns to preserve the purchasing power of the funds and meet charitable needs over the long haul. So that 3-year number has dropped, yes, but a lot of that's this negative bias that we've seen just in 2022. Now, if we go down a little bit, I want to show you where we are in the current allocation. You'll see a 29% equity here in the U.S., 24% internationally, and then that left 22% in the fixed income and cash category, 23% in our alts, which is actually very good to have those because they just provide a little more consistent, stable returns, not quite as volatile as the equity markets, and then the last little piece over in cash. On the next page of this chart, I want to point out that all the sectors for this year have gone negative. So on the second page, if you look at that quarter to date S&P 500 sector, everything is negative with the exception of energy. And we've seen actually a 27% increase in energy this year. But you can look at the price of oil and just see the boom, the concern for that. The demand has gone up incredibly. And so that's why you see the positive return there. And that's the only sector that's that way. And that's in the S&P 500 US, basically top 500 companies here. If you look in the bond market, same story, if not everything is really negative except for the last 12 months in a high yield investment. Everything else is negative for the quarter and for the year. So again, as we've seen interest rates going up, that puts pressure on your long-term total return for fixed income as we see it now. So it's 2022 has been a tough, challenging year, and that's where we're going to turn to Robert because he's going to tell us a little bit of why that's happening and what's going on in the market.
Will do. Thanks, Chris. And I'll just go full screen with this. So kind of picking up where Chris left off, actually, we closed last year at 4,800 on the S&P. And as you can see, kind of through the end of February and really where we're trading at now, even, with the overhang of rising interest rates, Fed action, geopolitics with the very challenging and very frightening situation that's unfolding in Ukraine. We're approximately down, as Chris mentioned, just over 11% on the S&P, at about 17% or so on the NASDAQ. The markets were starting to trend lower prior to this, the geopolitical specter that we have before us. And that was because of two key factors: inflation and interest rates. Inflation was on its way higher because of the supply constraint that we had placed on the economy with the COVID challenge and the slow reopening of the economy, Delta and Omicron variants kind of exacerbating that, keeping those supply lines, supply chains clogged. And unfortunately, the Ukraine invasion does the exact same thing. It basically exacerbates that already existing challenging situation. So as you can see on our chart here, obviously, this was the concern over supply, inflation, and the Fed policy started to regain the footing in the market but obviously the Ukrainian invasion has changed that picture. In fact, today we are supposed to see the Fed make the first of our interest rate increase moves. Now, why are they doing that? They're actually trying to combat inflation. They're looking at the economy and basically saying we have full employment, which is their first and primary job. And that's a good thing. That's a healthy factor about the underlying economy. And we do have consumer spending, despite high energy, high commodity prices, is still robust here in the US. So the underlying economy is doing just fine. So it's now the job of the Fed, and many think they're kind of behind the curve or a little bit late to acting, to increasing interest rates to take away some of that stimulative measure that we had in previous years, and to try to keep the economy, quite frankly, on that even keel. Now, unfortunately, today, we do have a conflict before us, and we thought it would be beneficial to share with all of the participants of the foundation how the market has reacted to previous conflict scenarios. And there's kind of one of those adages that we say, it's always buy the rumor and sell the fact. The market always acts as a discounting mechanism, trying to price in the event beforehand. So I think what's more important here is when you look at prior to the Iraq war, for example, you can see almost the exact same chart type setup that we had at the beginning of this year, with an increase leading up and then the actual event. Similar again with the first Persian Gulf War, and again following the Syria war / invasion that we saw in 2011. So it's a similar mindset that the news is always darkest kind of before the event actually happens. Yes, you do get some tumult and volatility through the event, but then following on from that, the markets do tend to adjust. Those supply lines in the economy adjust as well. And that should be a more hopeful factor. As Chris mentioned, fixed income has not necessarily been a place of solace or comfort for investors this year. As we're looking at performance here on this chart through February, you can see actually US 10-year government bonds are down approximately 3%. US investment grade corporate bonds are down approximately 5.3%. And this is typically the area in asset allocation where folks will go to for diversification benefits. And that hasn't really played out this year. It's been both equity markets declining and fixed income markets because of the rising rate increases. Now, the good news, of course, and one of the reasons why the foundation performance is actually holding up very well, obviously compared to what we're seeing in the equity and the bond market. We do hold ourselves to a high standard with the composite benchmark there, is the fact that we have used some of the alternative strategies. There's one strategy, for example, that is commodity sensitive, which is basically long some of the industrial commodities, some of the energy commodities, which you've actually seen moving well. And there are other strategies that basically have defensive positions. So should the market encounter a shock, they buffer that potential drawdown. And we've seen those working well for the foundation. And it all goes back to the objective that Chris said very well by the foundation's policy, of course, to keep the distribution and the stability of the funds. We can't manage returns in the market, but we can manage risk. And that's exactly what you're seeing take place with the foundation's funds. Now, I do want, while we've got kind of time together today, and many of you might have been seeing, of course, in the news media, all of the almost hysteria around energy prices recently. So we thought we'd do a favor and try to put some of that into context. And while yes, clearly the energy mix globally is changing. Russia was obviously a very large producer of energy. In the US, we used between 7 to 10% was part of the energy mix that we would previously import. Now, of course, that's being cut off. And the specter or the worry behind that was obviously causing oil prices, and then follow on gas prices, what we see at the pump, to raise as well. So kind of putting this into context, we see oil today, it had hit a high of around $120 a barrel. And this chart was actually through March 9th. So even then, as you can see, in an evolving story, it's we're trying to provide the latest information, obviously, to you and the foundation. But even then, you can see energy prices have moderated since. Actually, we're trading at around $95, $96 a barrel today. But if you look back in historical context, the 2007 time period, the price per barrel adjusted for inflation was actually greater than 160. And many, we have a more robust base to our economy right now. It can stand that $120 oil. We didn't necessarily all kind of change behaviors overnight when we saw that happen. And that does not necessarily risk pushing the US into recessionary scenario afterwards. And in fact, from the early 2010 through 2013, we were operating at a sustained higher level of the price of a barrel of oil. So it's actually not as challenging. You see a headline number of above 100, but putting it into context, obviously, with where we've actually been in the past, it shows a little different story. And here's the other thing that's a good advantage, really, for the US economy over some other parts of the world. If you take a look at the Baker Hughes rig count, that is how many oil rigs are now actually operating in the system, you can actually see we've gone from next to nothing in 2020. And in fact, doesn't seem that many days ago that we were talking when oil had technically in the futures market actually hit zero, which was interesting. You can see that spike down in oil prices. Clearly, rig count was at an all-time low, but it's been trending higher ever since. Now, there are a couple of factors that come into play there, actually getting workers to be able to go onto the rigs. But the beauty of almost the US system is it's self-correcting. It corrects on price as a measure. So as you can see, as price has been rising, our rig count has already been increasing. So we're fortunate in the US. Europe, it's a different picture. In Europe, they were reliant much to a greater degree on that Russian gas. We already saw the cancellation of that Nord Stream 2 pipeline project. The billion cubic meters that it would take Europe to get completely off of that Russian natural gas is just under, it's about 140 billion cubic meters. And they've already identified some key strategies to be able to get there. Basically, other energy efficiency measures. This is where you see the European leaders saying, turn down that thermostat by 1 degree. That measure alone is almost 30 billion cubic meters. Turning on some of the other biomass projects, nuclear projects, and other renewables can get them a good step of the way as well. In fact, so much so that the UK government has said they'll be able to be off Russian natural gas by the end of 2022, which is actually quicker than many had expected. So we hope those stats, as far as what we're seeing before us today, will help kind of provide comfort that the foundation strategies, clearly, though we didn't see necessarily an invasion coming, but we had some of the defensive strategies in play already to mitigate the downside impact of this. And underlying, once we get through this situation, the US economy is still on a healthy footing. In fact, it's probably even more healthy for the market to see some of the more frothier valuations that we had achieved by the end of 2021 reset, and that provides a much better base for the investing environment as we go forward. But we do obviously still stay vigilant in time periods where there is this heightened volatility, and rebalance the funds automatically as necessary when we see those events. Angie, I'd turn it back to you actually then.
Questions? Becky loves all this stuff, so she might have questions.
And I don't have questions. I love to get this overview, though. I think more of our affiliate boards need to hop on here and understand what's going on. I really, I encourage them, but they don't come. At least if they start asking me questions about the performances, I always defer to this quarterly event that they can get on, ask their own questions.
Perfect. Yeah. And it's good that we have the recordings then.
Yeah, for sure. For sure.
Yeah, just some of the details you shared there, I think are reassuring, give some comfort of looking back when you showed the prices of oil and gas, back in 2007, 8, that's when I was still living in California, and I was paying that $4.25 at the tank, and I was making my transition back to Kansas, but I remember that time very well because I was like, I need to get out of California.
That would feel,
like,
that creates movement. I was going to say that would feel more like an inflation adjusted $7 a barrel, or $7 a gallon, what you'd be seeing right now. And one of the things I failed to mention actually in the outline, we were asked, obviously, a question of the day back in February was Russian exposure direct Russian securities. And the answer to that is quite interesting. You'd be surprised to learn that the Russian market itself is actually very, very small. As a percentage of global equities, Russian equities accounted for about 0.6%. Sberbank, Gazprom, and Lukoil were about the biggest companies that you would see. Even in emerging markets, Russia was only about 2.6%, 2.9%, I think, prior to all of the sanctions and so forth. The Russian market has been de facto closed now, basically since the start of Putin's invasion. We saw the ruble, basically trade at its lowest level ever since the dollar. These economic impacts are real, and they will be, unfortunately, quite lasting. It's so sad to see. This is almost like, take off not only the last 30 years worth of progress, but more like the last 80 years. It's going to be that profound. The knock-on effect, though, of course, was more, all right, everyone's got to adjust to how they're going to do business. This is where you see the McDonald's stores, for example, closing down. Okay, so that's more than the impact here for McDonald's shareholders now recognizing, okay, we've cut off a market of about 140 million people. That's where the economic impact really will lie, and you'll start to see that in some of the next quarterly earnings announcements.
Hey, Rob, something I would add to that too, which is, I think, kind of fascinating, is that the state of Texas' economy is $400 billion larger than Russia's economy, just for a perspective.
Yeah.
And per capita, that is $58,000 per Texas resident compared to an $8,700 per capita in the country of Russia. So it's huge landmass, huge disturbance, obviously, kind of wrecking the world's view right now, but just from a pure financial play, it's much, much smaller than what most people would think.
Yeah. Then the other topic of the day, just while I know we got just a little bit of an extra time, interest rates. So obviously I mentioned the Fed is moving today. They're likely to do a 25 basis point rate hike. Prior to the Ukrainian invasion, many were expecting between 6 to 7 rate hikes this year. And we went from basically zero yield on the 2-year Treasury all the way up to about 1.7. That's kind of the market where you'll see interest rate moves factored in quicker. And the 10-year Treasury yield went north of 2. I think it hit 2.1. Chris fact checked me on the height of that. We hit around 2.1. Obviously from 1% last year. That's why you're seeing losses in the fixed income market in particular. But this Ukrainian situation tempers the Fed expectation of what they might do. And in fact, it's come down from, as I said, around 6.5 projected rate hikes to more between 4 to 4.5. So it's going to be very telling seeing the language today. The market may already have, it's interesting. You've got a Fed that's behind the curve, but a market that's probably ahead of the curve in what it's priced in. The correct answer is somewhere in between. So we might actually see a boost in bonds if the bond market says, oh, okay, it's not going to be as bad as all that. It's only going to be 4 rate hikes. You could see improvement in bond prices because of that.
Yeah, and the 10-year closed yesterday at 2.16.
Oh,
so just
close.
north of the 2. Yeah.
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 Very good. Well, I think this is great. I mean, we appreciate your updates and clarity and hopefulness is what I'm going to take away from all of this. And, we'll continue to monitor it. We also always welcome our affiliate board members to attend Finance Committee, 3rd Thursday, 4 p.m. Sometimes Zoom, sometimes in person, sometimes hybrid. So we keep adapting to whatever the needs are these past 2 years, but we welcome participation from any of our affiliates to tap into those meetings. Usually we're blessed with one or both of the consultant group members, so we appreciate that. And are there other questions? Bill, as you're getting your legs again, anything come up or have questions or?
No, again, just getting back as we had a board meeting yesterday and we began to talk about impact investing, and that generated some questions there's a couple other bankers on the board, and it kind of refreshed my memory. And so we'll be interested to watch how this thing goes. This is helpful. I appreciate the update on the market, Robert, and the others. That I'm kind of into that, I guess, but it helps me to know, should questions come up, what's going on. It feels kind of like from a semi-distance that the foundation has a pretty good plan in order to weather those tough times, the times when you go down as well as up. Yeah. So it right here, from what I've seen and feel, it feels pretty good. So. Okay.
Appreciate it. Well, we appreciate your time. There's no reason for us to belabor our call any longer. 40-minute presentation was terrific. So really appreciate your time and investment. And I'll see some of you tomorrow at Finance. And from there, we'll call the meeting.
Okay, bye-bye.
Thanks, everyone.